Welcome to Stocks in Translation, broadcasting from the New York Stock Exchange. I'm Blikre, your host, and with me is the people's voice, Sydnee Freed. First, we ask you to kindly like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today we are welcoming Victoria Fernandez. She is a chief market strategist and fixed income portfolio manager at Crossmark Global Investments. And today we're going to be talking about fixed income, the bond market, as you know it. Our word of the day is liquidity. It's one of those words that makes you seem smart at a cocktail party, but there's a lot of nuance in the financial sense. We dig in. And this episode is brought to you by the number 2. That is the number of large cap S&P 500 sectors now in the red for the year, why the mega caps aren't finding investor love in 2025. So Victoria, I'd love to get your big picture thoughts on the market action that we've been seeing. A lot of bearish action, but what's your take?
Yeah, so we've had a lot of volatility going on, obviously, and it's not just one specific thing that's causing that. We've had volatility because of monetary policy, fiscal policy, regulatory policy, trade policy, you name it, and there's elements that are causing the volatility that we're seeing right now. And that's led to a lot of concerns around growth that we have here in this economy. Obviously, that's pulling the stock market back. It's pulling yields down because there's concern around what the growth looks like. I think, in my opinion, and we can dig into it a little bit more, but I think it keeps the Fed on pause, even though we've seen more rate cuts get priced in as of late. And I think it just puts us in more of a defensive posture.
I think this is a good segue to our word of the day, which is liquidity, because it affects all these things. It's not just for Gordon Gekko. Liquidity refers to how easily an asset can be quickly converted into cash without disrupting its market price. And liquidity in the bond market in particular is front and center with the new administration. We've been trying to decode this new playbook. And how does bond market liquidity and all its wonkiness fit into that?
Well, if you can figure it out, let me know, because we're still trying to work on that too. But liquidity is a key component. And yes, it's how easily you can rid yourself of a particular holding. But liquidity is also how much money is at work in this economy. And because of the debt ceiling debate that is currently going on, the Treasury is having to put money into the market. That's adding liquidity to our market. And there is a very high correlation between extra liquidity in the market, lower bond yields, and a lower US dollar. So a lot of people have seen yields really moving around, trying to figure out what's driving it. And I don't think they realize it's liquidity that's a main component of that.
Can you break down for me what it means when you're seeing more liquidity in the bond market to an average investor? Like, what does that mean to an investor who's in bonds of any sort?
Right. So you always want to have holdings in your portfolio that do have high liquidity because you want the flexibility to be able to trade them easily. You don't want to buy something, have it in your portfolio, need to sell it, and you can't because there's no one on the other side willing to take that bond from you. And so that's why you've seen a lot of money flow into Treasury markets, because that is your most liquid asset that you have. But tying that again to how much money is flowing in the market as a whole drives yields. And so having extra cash in the market that you didn't have before brings yields down.
So extra cash, lower yields because there's not as much demand. And so the price, what you get back kind of goes down, is
right.
that it?
There's more of it,
There's more
right? So it's not like it's, back when I was a kid, it was the Cabbage Patch dolls. You would run from store to store because there were only like 10 at each store. Okay, we're not in that kind of scenario as more cash gets put into the market. Now, at some point, when the debt ceiling does get raised, because we know it always will at some point, when that does, you'll see a little bit of reverse of this liquidity component in the market, and you'll see yields move back up a little bit. So it's fluid, it's constantly changing, but it's definitely something we need to be watching.
I want to ask you, who's buying U.S. Treasuries right now? Where does that demand coming? We've talked to a number of guests, Chris Whalen recently, and some of them argue that there's not the demand that there once was, especially internationally. Mm-hmm. And yet, when we see these higher yields, whether it's in the 10-year or the 30-year, they get to 5% or they approach that, suddenly there's a lot of bond buying going on. So is there a magic threshold here? So who are the buyers of Treasuries and what are the levels you're watching?
Yes, I'm going to raise my hand.
Yes.
I'm one of the buyers of treasuries for our clients, right? When we manage these fixed income portfolios for clients and they're looking at concerns around the economy, concerns around credit spreads and what's happening, there is a flight to quality, and that leads people into buying treasuries even as yields are going lower. And so now you look internationally, you're seeing yields start to move higher in Europe. So people are wondering, are there going to be less buyers of the treasuries here? There's not. There is always a demand for treasuries, especially when there is concern about the strength of the economy. It is that flight to quality. It's what every investor automatically does, is where's my money going to be safest? And I say that in quotes because, nothing is ever 100% safe, but where can they hide a little bit in the fixed income market? That's in the treasury side. So you see a lot of people purchasing treasuries, both on the short end, because those yields have been quite high with the Fed keeping rates where they are, and then adding some on the longer end as well so that you can continue to have some cash flow over the next 5-7 years at these levels.
Do investors with a longer runway, though, need treasuries right now? Or
She's saying she's so young, she doesn't need boring bonds.
I'm trying to get some advice over here.
Yes.
30 years old, I don't know. 31, oh God. Do you actually need treasuries?
I think you do. And the reason I say you need treasuries is because you want to have some consistent cash flow in your portfolios. If you're going to have volatility on the equity side, what can help buffer that? It's solid cash flows in your portfolio, generating that cash. And you're going to get that right now, some of the highest levels in treasuries. Now, as things start to change, as people are more confident in corporates and we see yields, really
Corporate
strong
bonds.
yields there in corporate bonds, you'll see some buying there as well. But because of the quality of treasuries and the level of yields that you're getting, that cash flow generation you can get out of shorter term treasuries, it's a place that people are using in their portfolios.
Let's talk about corporate bonds here. You have investment grade, which is a safer side, high yield, which gives a higher yield. But it's also a little bit less safe, a little bit more risk there. And you mentioned credit spread. So maybe you could kind of break that down too, because that can be a signal. If banks suddenly, or if corporate borrowers have to pay an elevated rate, that can be a signal. So how does that all work?
So it's all tied together. It's just like if you go to buy a home, right? And maybe your credit score is not as strong, you have to pay a higher rate. Right, on that loan. Think of the same thing when it comes to corporate bonds. If the company doesn't have as strong of a balance sheet, if it doesn't look like they have these solid cash flows, their coupons are going to be higher. And that is determined off a certain amount on the treasury, right? It's based off of the treasury. So high yield bonds that you talked about, they don't have as good of a credit score, for lack of a better word. And so they have spreads that are higher. They have to pay more interest to people that are buying their bonds. This is what we kind of call the canary in the coal mine. You talk about it being a signal, Jared, right? And we do use those spreads as a signal as to what could be happening in the market. And right now, those high yield, those less credit-worthy corporate bonds, we are seeing spreads widen out. There is less, finally, right? It's been a long time, and they've been very tight. We're seeing that widen out, which says people are getting a little bit nervous. That has not flowed through to investment grade yet, which is your more solid companies that don't have to pay as high of a premium. We're not seeing it there. We'll see if that starts to flow through. In my opinion, that will be the time that you can say, maybe we're starting to hit a tradable low here in the markets when we see investment grade spreads widen out. So definitely something to be watching.
How do people research these kinds of bonds and decide to invest, or how do you even invest?
Like ETF-wise, so somebody with a plain vanilla brokerage account, what can you do here?
I was going to say, you come to me. That's what I'm here for.
Excellent.
You come to Crossmark and say, what do we do? But again, if you're looking for a place to hide a little bit because you are concerned about the growth in the economy, you're concerned about different policies that are coming down the pike, then you want to do something safer. You look at ETFs that are shorter term treasury, high quality corporate bonds. Those are the elements you want to be in. typically, our clients, at least at Crossmark, are not using their fixed income strategies to add risk to their portfolio, but some people don't mind taking additional risk, and if so, then there's other elements of the market. There's high yield bonds you can look at, there's leverage loans, there's all sorts of things that people can utilize, but I would think most people, an average investor, is using this for more of a safe haven, so you're looking more towards Treasury or high quality corporate bonds.
I've noticed there are actually quite a few new ETF products out there that are playing the cash side, the really short-term end of the yield curve. Is there anything there? Because sometimes, like a magazine cover, when you have like the bond markets front and center on Time magazine, that's actually a bad time. If it's saying bullish on bonds, it's time to be bearish. Is there anything there in terms of these new products that are coming in? Like, is there going to be an exodus from cash? Are these shorter durations not going to be as in favor?
So if you look at ETF flows, and you probably did since you asked this question, look at ETF flows over the last few weeks. A large amount of those flows are going into short-term Treasury, short-term fixed income for that sheer fact of what we're talking about. Higher yields, less stress in the investments that you have there, higher quality holdings. So you can actually, what we do, what we call a barbell. And I think that's what you're seeing a lot of people do. Locking in on some of those very short-term treasuries, those ETFs that cater to that short end of the treasury curve, locking that in, getting some of that benefit, but then going out a little bit longer and locking in there as well, knowing that yields probably won't stay at some of these elevated levels forever. They are going to come down, and you want to lock in some of that for longer term.
What % of your portfolio should be in bonds? I know it'll be a little different for everybody.
Right.
But are you a 60-40 person, some other
Sid's
number?
thinking 5.
Yeah.
I'm like, yeah.
Right. As a bongo, I do want to say, oh, you need to be all bonds, but that's not appropriate for everyone. So I will say one of the best selling strategies we have at Crossmark, we call it our balanced core strategy. And we do take our large cap core equity and combine it with our core fixed income. People love having that combination in one portfolio, and it's 50-50 for us. And we do allow a 10% swing because you want to be able to take advantage of one part of the market moving higher. You don't want to always be in there trading and reallocating it, so we allow it to swing a little bit. But 50-50 has worked well. I know 60-40 historically is what a lot of people put in their portfolios. Some people even go 70-30, but it depends on your risk tolerance, right? So people have to work with their advisors, look within themselves, how much volatility are they willing to take in their portfolio. But I think everyone, even people in their 20s, 30s, as they, even when they're young, it makes sense to have an allocation because it generates cash flow for you.
And hold that thought there because we got to take a short break. Coming up, we're going to be talking about some sector rotation and the animal spirits make their way to the runway for today's Who Wore It Better. This episode is brought to you by the number 2. That is how many large cap sectors in the US are in the red this year. And it's not just any 2. It's specifically tech and consumer discretionary. So tech, that's Apple, Nvidia, Microsoft. In discretionary, it's Tesla and Amazon, where we've seen a lot of selling recently. So last year's big winners, the mega caps, especially post-election, are now kind of the dogs of the market. How do you see this rotation playing out, especially in the bond market, your wheelhouse?
Yeah, so we talked a little bit earlier about, the concern, the growth concern that we have in this economy, and that is what you've seen, this rotation. You've seen those elements, those Mag 7 names, those tech names that a lot of people thought of as places they could hide in the market and be safe havens. They've really come back, and you've seen some of the more defensive categories start to take over. You talked about the 2 worst performing sectors. You look at the 2 best performing sectors.
Staples and
healthcare,
okay.
Right? And utilities is up there as well, but it's those more defensive components of the market that have been leading. So even on the fixed income side, when we're looking at where would we want to allocate within the corporate bond allocation, we want to look at those sectors that are doing well with strong balance sheets, good earnings, same reasons that maybe they might be doing well in the equity market. will be good reasons that we want to hold their notes on the fixed income side. So looking at some of those same sectors, financials, I know there has been a pullback in financials. They were, leading the market for such a long period of time, and they're still in an uptrend. So I think with some consolidation we've seen in that sector, that's an area where you could go both on the equity and the fixed income side as well.
If a sector is doing well, though, isn't it kind of a little late to get in? Like, don't I want
That's the way it always feels, right?
Yeah, don't I now want to pile into tech if I think, well, no way tech's going to be down for long?
Right.
Isn't that kind of thinking, no?
There's an element of that, absolutely.
Buy the dip.
Yeah, there you go. You don't want to chase the market, right? But you don't always just say buy any sector that's down, because there may be a very strong fundamental reason that this sector is down, and therefore it's not an area that you want to put money to work. So we were just talking about financials. Yes, they've come back some, but they're still in a long-term uptrend. That's what you want to look for. Which sectors have had some consolidation, but their long-term uptrends are still positive. Those are the areas that you can go into. If I've seen a sector like tech actually turned over the last couple of weeks to negative relative strength versus the S&P, that makes me a little bit nervous for parts of the tech sector. But you can't treat every stock in a sector the same. There are elements within tech that we would actually buy. So you have to be a little choosy, do your homework, make sure you're buying companies, like I said, with those elements like strong balance sheets, good earnings.
What are those elements you would buy?
That was
in
my
tech?
question.
Yeah.
And so in tech, semis versus software has been a big debate that we've had this year, and semis have really struggled. I think you can look at some of those other areas. So Cisco, for instance, is a name that we would put to work. It fits this mold of what we're talking about.
Legacy tech.
Yes, absolutely. Some of the legacy tech things. And then you see news coming out about Taiwan Semiconductor trying to partner up, right, with some other companies and maybe do some things with Intel. So I think you have to maybe come out of those really high beta names. That's where you've seen a lot of the rotation that we're talking about in the market, those high momentum, high beta names. Maybe stay away from those and look at some of the other elements and sectors that you can kind of start dipping your toe into, and they'll have an upward trajectory going forward.
Makes a lot of sense. Wanted to just talk to you broadly about the playbook. It seems like, especially over the last few weeks, and we're in the middle of March right now, that there have been some correlations which have held over the last few years, which are kind of breaking. Looks like the dollar isn't quite moving with long-term rates the way it was, and in the market, I just hear lots of anecdotal stories of all this pain trade that even hedges are blowing up. So the market's going against you in your main position, and then your hedge also blows up. So it's a double whammy. Is the playbook, do we need to rip it up and just start a new one, or what are we to do here?
Yeah, it's interesting. Everyone says history doesn't repeat itself, but it rhymes. I actually don't feel like it's rhyming much right now. I think you're right. There's a lot of different elements going on, and I think it's because the market has been priced for high valuations, high earnings, high growth expectations. So it really wasn't set up to take any bad news whatsoever. And we've had quite a few things that have kind of stirred the pot, for lack of a better phrase, as of late, and really caused some turmoil in the markets. And I think that's why we're starting to see some things break down. Do those relationships still hold in an environment where you're not at the Fed's inflation target? You had really high growth expectations a couple weeks ago, and now all of a sudden there's concern around the consumer and what they're doing. We have switched from an administration that had tighter monetary policy and looser fiscal policy. We've switched, right? Now we're getting tighter fiscal and perhaps looser monetary policy over the course of the rest of the year. That's making people kind of challenge the correlations that we've had before. So I think you have to do a little bit more independent study than just take history as how it's been.
At the beginning, though, you sort of said between monetary, it's all kind of a little volatile right now, which is what we're seeing in the markets. How does it then stabilize? What's going to kind of make investors...
How do we find equilibrium?
Yeah. Because it feels like we might not find it anytime soon. At least that's what it seems like to me.
It seems like that from a headline perspective, for sure. And I completely agree with that. So when we have our meetings with our advisors and with their clients, and they're asking the questions, what do we do, right, to avoid some of that volatility? It goes back a little bit to what we were saying earlier. find that portfolio that works for the risk level that a client has. You want to have exposure to certain parts of the market, but you want it to be in those stocks that have that uptrend. Find some exposure in the fixed income side of the market, in some treasuries, and some safe haven elements to help buffer the volatility on the equity side. Is there one place to go right now to hide from all the headlines that we have? No. And are we going to have continued volatility? Absolutely, I think 100%, whether it's geopolitical, whether it's fiscal, whether it's the Fed and what they're going to do with monetary policy. I think there's so many balls in the air right now that you just have to take a little bit of a step back and put yourself in that defensive posture and wait for things to cool off a little bit. Hopefully that's soon. I don't know, but we're thinking middle of the year. We're thinking middle of the year, you might start to have a better roadmap of what there is to come. And that's the problem right now. It's not that things are happening, it's that there's people don't feel the plan and they don't know what the roadmap is, and that's what's concerning them.
All right, we want to pivot. No segue there. It's time to take to the skies for this fashion showdown that we have on today's Who Wore Better. We have two iconic aviators, each with a different economic style. Swooping down on one runway is the Hawk, leading its razor-sharp talons and no-nonsense policy stance, ready to tear away the echoes and vestiges of the pandemic inflation. Quick to raise rates, perhaps. It's ready to strike when the data demands. On the other runway perches the Owl, the wise watcher of the markets. Patient, observant, adjusting with care rather than by force, not quick to flinch, and always aware of the bigger picture with its 360-degree view. So, Victoria, when it comes to monetary policy, and I understand you might be a little biased here, is it who wears the economic zeitgeist better? Is it the Hawk or the Owl?
So you're right. I might be a little biased because I do say my spirit animal is the owl, because I do fit those characteristics you were talking about. When it comes to monetary policy right now, I do think the Owl is going to be the best choice here. I think when you look at Powell, although there has been a hawkish stance to them or a tilt to them, I think they're going to be very slow to move here. There are concerns if they start cutting rates too soon, with inflation still at 3% on core CPI, you still have that 3% handle there. They could stoke some fears of inflation, add in concerns about inflation's coming from tariffs. I think they want to be very careful in lowering rates from where they are.
That's the dove.
Right, from lowering rates. But they also need to be careful because they don't want to have that hawkish mentality that scares the market then and pushes yields higher on concern of increased inflation. So I'm going to say they're more like an owl, and they're going to kind of sit on the sidelines and see what happens for the next couple meetings.
Very nice.
All right. We've got a little less than a minute left. You say you love your job because you can help people achieve financial security.
Yes.
So as we wrap up, what's the biggest mistake that investors are making right now?
I think the biggest mistake, and we see it often, and we try to help people understand, we said earlier, don't chase the markets when it's this volatile issue going on. Clients tend to want to sell when things are low and buy when things are high, right?
That's
the opposite of the old adage. That's exactly right. So we want people to take cautious approaches to their investments, really think things through, and have a consistent approach where you're not making knee-jerk reactions to headlines that are out there in the market. That's where they get caught.
All right, and that is going to do it for today's Who Wore It Better and Stocks in Translation writ large. Be sure to check out all our other episodes on the Yahoo Finance site and mobile app. We will see you next time on Stocks in Translation.